What's going on, guys? Welcome back to Real Estate Defined. Today, we are going to talk about earnest money versus down payment. I hear it get confused a lot. They kind of lump it in together as one lump sum when really they're very different. So earnest money is essentially good faith funds that you pay to the seller at the beginning of the transaction. Here in Colorado, 3 days after you go under contract, that gets held by the title company, keeps both sides honest. If the seller decides to act unfaithfully, buyer gets to pull out their money. If the buyer acts in a way that's not in good faith, the seller has an argument to keep that earnest money as well. It essentially goes towards your closing costs at the very end of the transaction. So everybody's familiar with down payment, which is a percentage of the purchase price of the house. Earnest money in Colorado, it's usually 1%, but negotiable, is also a percentage, but it's given to the title company. So the difference being the lender requires the down payment so that they can figure out what your loan amount is, if you need mortgage insurance, what your interest rate's going to be, monthly payment, so on and so forth. Earnest money is held in an escrow account that allows you to essentially walk through the contract during the transaction, and at certain points, if you walk away, you can take that away. At the end of the contract, when you guys go to the closing table, you have a certain amount of closing cost. The earnest money, whatever that amount is, goes towards that closing cost. So for example, if my closing costs outside of the down payment are $8,000 and the earnest money that was owed is $4,000, that earnest money goes towards closing costs. So at the closing table, you only have to come up with $4,000, not an extra $8,000. So hopefully that clears it up. If you guys have questions, let us know. Make sure you like, comment, and follow, and subscribe to the YouTube channel, guys. We'd love to get to know you. Thanks.